All right, folks, welcome back to the Property Couch podcast. Have we got an exciting episode for you today? It's a MythBusters episode, all with regards to lending, all the stuff that we see at the coalface, and we're going to answer, are they fact or are they fiction? We're excited about that. But what else are we going to cover, Ben?
Well, mate, as part of that, we're going to be talking about a bank staffer causing immense damage to a client's finance structure. So you're going to hear us unpack the problems with the advice that they've got from that particular bank. In addition to that, in What's Making Property News, we're all over the Queensland rental cap story. So stay tuned for that one. And finally, I just thought I'd walk in, register and buy a property. And that's what you're going to also hear about in What's Making Property News.
Big show, folks. Lots to cover. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast. Hello, Ben. How are you? You up and about, I'm sure.
Well, let's just say if there was an award for March premiers, we'd be putting our hand up. We'd be putting our hand up at the moment. No, I went and had a look on Saturday. In fact, I spent an hour and 40 minutes in the car just trying to get to the ground, which I hadn't experienced before, thinking we're playing Port Adelaide, but obviously a record crowd against Port Adelaide. But it took me forever to get into the game. But when I got in there, I was pretty happy with what I saw, Bryce. Yeah. So that's all I'll say. So it's a long season, though, mate. It's a marathon, not a sprint.
You ever catch the train in, mate, or
I have.
Mooney Ponds doesn't sort of,
Well, I had to go out all the way out to not Kangaroo Ground. I went out to the back end of Whittlesea there, up in, I'm trying to think, it's Kingvale or something like that up there for a birthday party. So I had a long drive to get, so I had to get out of there quick and get home and get the kids together because I was going to an 18th birthday party. There you go.
Oh wow!
Yeah,
let's just bleep that out. Like, what's going on there?
Well, so that's my.
Going to an 18-year-old.
That is my high school friend's son's birthday, and we've obviously been in contact for many, many years. Great friends of ours, and so happy 18th birthday, Samuel.
Very good.
Yeah.
Glad to hear you're having a good time at the footy, mate. Good to hear, mate.
How about you? Were you
not talking about the footy?
Okay, we're moving on. Rightio.
We mentioned that before. We're not talking about the footy.
All right. Well, we've got a great show today, though.
We do have a great show today. We have decided that we're going to do a MythBuster series, Ben.
Great.
And so what we did, you and I, is we went around to each and every one of our core offerings within the business, and we said, what are some of the questions that you're hearing at the coalface that do not line up with what's actually happening in the marketplace, right? So it could be an article you've heard that people come and reference to, or anything like that. What is it? So we've got core myths that we want to talk to and we want to bust them. So I'm excited about that, Ben, because hopefully that'll add some value to our community. But I wonder if anyone else has some of these in the back of their mind as well, which we'll find out later on today. But my Mindset Minute theme today, Ben, is when I say classic books, Ben, what would come to mind for you? And this is not a trick question. What do you think sort of hits a classic book?
Yep. So books that I keep going back to. Thinking Fast and Slow. That's obviously the masterpiece. I'd be thinking of Money Psychology is another good one. Obviously, James Clear with his Atomic Habits. A Rational Optimist is another fine book that I thoroughly enjoyed.
The classics, right? Yeah. How to Win Friends and Influence People. Think and Grow Rich, right? Anything by Napoleon Hill. Now, we didn't plan this, but you referenced the very book that I think will become a classic, and I think history will prove that to be the case, which is Atomic Habits by James Clear. It is an absolute game-changing book. If you haven't listened to it or read it, I reckon you should. If you haven't listened to our interview with James Clear, I reckon you should. So I'm going to do a James Clear quote today, and it's if two people have the same goal, you know nothing about the similarity of their results. But if two people have the same daily habits, you can infer quite a bit about the similarity of their results. Your results are largely the byproduct of your habits. Now, anyone who's listened to this podcast will know, okay, Bryce, yep, thank you, nice reminder. But I just happen to think that the habits that we do are so incredibly crucial to the success that we have that I like to come back and reinforce this point, right? Because the habits are so crucial in shaping our lives that the results are largely around the habits that we cultivate. So I think about this in terms of if you have two people whose goal it is to invest in property, you know very little about their results, right? But if you have two people who've set the goal to actually trap surplus by the end of the month, you get a better understanding of what they are likely to be if they become a property investor. So the fact that we have the 7-day float, if someone can stick to the 7-day float and not go back to the well and see that over a consistent period of time, and then at the end of the month have some form of surplus, gives us a very good indication of what they would be like as an investor. Versus two people who say, I just want to be an investor, doesn't give us any indication, because we've talked a fair bit about the fact that a lot of people derail. They buy an investment property for whatever reason. We're going to talk to some of those points over our myth-busting series over the next couple of weeks, but they derail in some form. So I just wanted to do that, Ben, that you can infer quite a bit about the similarity of someone's results based on the daily habits that they do. So my question to everyone listening to this, are you doing daily habits that are actually working towards you having a surplus at the end of the month? And if you actually are having a surplus at the end of the month, are you putting that surplus to work? And if you're putting that surplus to work, chances are the results will just take care of themselves. So there you go. Ponder that, Ben.
Well, funny you should mention that, and obviously it's the first I've seen your Mindset Minute today was the MoneyFIT area of the More platform allows for obviously insights into those areas, right? We're actually doing some tweaks on that. So in a couple of weeks' time, I'm hopefully going to be announcing something around, MoneyFIT 2.0, where we are talking about wealth clock, wealth speed, and some of those sub speeds, and you'll be able to also have a look at that. So to your point around trapping cash flow and building up savings, you'll start to also then be able to compare yourself in terms of the saving speed and some of those other sub speeds as well, which I think will be very insightful for those people who want to look at, if that helps motivate you or gives you incentive to see where others are at. We've always said, if it helps motivate you, that's awesome. If you put it in a competitive nature or it's a habit if you're building. In some cases, also you need to bring context around your own circumstances. So we've talked about that before. But if you've been studying for 7 years and you're behind the 8 ball, but your earning capacity is going to go up significantly over the next 5 years, you'll be able to not only catch but even pass some of those people as well. So, but as a broad context, it makes really good sense that build those habits, be disciplined around essential versus discretionary spending, and you'll get on your bike pretty quickly.
Talks to the flywheel concept too that we've spoken about, Ben, with Jim Collins, isn't it? Because to summarize the flywheel is to get big momentum starts with smaller steps in getting, just think of the wheel. If you want to get momentum, it's a little bit of a push and then a little bit of a push. And then over time, that momentum starts, and the momentum is actually what carries things forward, right?
Yeah.
So if you think about if someone's sitting here going, because we've had cases where people have written in and said, oh, look, we talked about it last week, we get it all the time, where people go, I don't think property investing is for me. It's like, well, okay, go just rewind the tape and see what are the little steps that you need to take to turn that flywheel. What are the daily habits that you need to do? Because if you want to invest in property, it starts way back here with money management. Do you, at the very beginning of the flywheel, it's do you actually spend less than you earn, right? Because if the answer to that is tick, it's great. That's a little bit of momentum on the flywheel. And then the next step is, okay, based on that, do you actually have a believable plan on how you're actually going to trap some surplus at the end of the month? If the answer is no, you need to get one. And then once you get that, then you put a rules-based system in for that habit. So then all of a sudden, and you can start to see how this flywheel will start to create momentum. Because at the end of the process, if you're actually able to trap surplus and you're actually able to show some discipline with money, and then you'd be able to go, well, okay, can I borrow some money? And this flywheel concept means that the success actually isn't a whole bunch of secrets that the industry would lead you to believe. It's just actionable steps that you do routinely and regularly over time. So
Love it.
I'm going to reinforce habits over and over and over on this podcast, Ben, because we believe in it. We built a money management system around it.
Yeah.
We implemented it ourselves. And compounding doesn't just work with interest. Compounding works with the things that you do on a routine, repetitive basis towards a meaningful goal that matters to you. And for us, $2,000 a week is the line in the sand that we've drawn. So there you go, folks.
Love it.
Ponder that for the rest of the week. Let us know if you know the flywheel concept, if you are doing these daily habits, and instead of setting goals for the big picture things, set goals for the habits that you want to employ. All right, Mythbusters. We're going to start from the finance part of the world, Ben.
Yes.
We're going to start with our mortgage broking team. We've asked them to give us a bunch of myths that they come up across all the time, and then you and I are going to talk to those. So we're going to kick it off with the first one here, Ben. It's a bad thing to have all your lending at one lender. Myth needs to be busted, Ben, or is that true?
No, I think in context, it needs to be busted. You could make a case for a couple of lenders as you get more sophisticated in terms of what you're doing. And remember, the game of finance is movements on a chessboard. So it all comes down to, if you know your long-term strategy, you can work back from that. But I would not agree with that statement that says, it's a bad thing to have all of your lending with one lender. I'd say, firstly, you get far better pricing. If you consolidate all of that lending with one lender, they will give you very sharp interest rates as part of that. I would also make a case that it's potentially easier to run your household finances because, again, not having to go to multiple banks to see the overall assessment. Now, of course, a plug for the More platform. You can see all that summarised nicely for you if you do have multiple lenders as part of that. And as you do get more sophisticated, and I put my hand up, I've got 1, 2, 3. I've got 3 lenders at the moment in terms of across my self-managed super fund and also my personal investing with my wife. So that gives you some context when you get more sophisticated. Less fees, mate. So when you're talking about fees, you're talking about annual fees, any setup costs, discharge fees, all of that becomes reduced because you're working with one lender. And so, the other big point for me is also around quicker and easy to process the loan application. So you've got speed to market if you're looking to take advantage of an opportunity. So there are some of the, again, I can make a case for it. So this whole idea that, it's a bad thing, just having one lender, I think is actually a busted myth.
Yeah, because I think early days it can be super helpful. Later on, if you get to a larger and larger portfolio, you may hit glass ceilings that having one lender doesn't necessarily serve you. But so to summarise what you said, less fees, one credit assessor, better pricing, quicker end-to-end process, so it can be quite straightforward. For some people who only like to log on to one internet banking platform, Ben, it means you can just have one app and have a look and see it all in one hit. But there could be a case. So this is why it's a myth that one lender is bad, because in some cases you might be in a position where you have to have multiple lenders. You might need to actually have better access to equity releases. They might have different cash out policies. Right now, more important than ever, borrowing capacity is super important, right? So you might have hit a borrowing capacity ceiling with one lender, but if you go to another lender or a second tier lender or someone who's puts add backs in a different way to other assessors, that may actually mean that the difference between you being able to proceed and buy another property in your plan versus not being able to with your existing lender. So there is a case for it to be horses for courses, but being told it's one lender is a bad thing, that is an injustice. It is not true. It is a myth. We want to bust it because ideally, as you accumulate over time, as you have, I have got multiple lenders. It may serve you, but it's certainly not a hamstring if you've got one, Ben.
Well, again, context for our situation, just looking at it, all of our residential property that we own in our individual names is with one lender. So the other lenders are in the self-managed super funds, to give you an idea. And we've got 2 properties in a company structure because they are going to be developed properties. So that just gives you some idea in terms of, if I'm an evidence-based story around busting that myth that all of our individual properties are sitting with one lender.
And pricing's right. I just recently repriced mine. They had a look at the value of the lending. I threatened to go somewhere else. I asked for the discharge form, the standard things that we've been talking about here, Ben. And lo and behold, I got my interest rate shaved, and I got cashback offer, Ben. So surprise, surprise, the stuff that we've been talking about on this podcast, it's not theory, Ben. It's practice. It actually works. We do it ourselves.
That's what we're here for, to encourage people to act on the information we share.
Yeah. So is it a bad thing to have all your lending at one lender? We say that is a myth that needs to be busted, because in some cases it's good, some cases it's bad.
Yeah.
In some cases it's not bad, some cases it's limiting.
Yeah.
But I think the important thing, and anyone who's a long-term listener of our podcast, if you're one lender, it's still super important to make sure you get the structure right. We're talking about cross securities versus standalone lending, and that's where the magic lives. If you make sure you're with one lender and you get the structure right, that means if you do hit any glass ceilings down the track, because you have the right structure, then you can go to another bank, which might have different cash out policies, which might have different servicing capacities. It makes it super easy because you're just pulling the deposit from the existing lender and going and get the borrowing from the other one. So there we go, folks. Number one, myth busted. It's a bad thing to have all your lending at one lender. We don't think that's true. Number two, Ben, if you could talk to this, please. Banks won't lend to me because I'm self-employed. Myth or fact?
Well, let's unpack it. So the truth is that self-employed borrowers are harder to assess from a risk perspective for a lender, because a lot of self-employed people, so 3 out of 5 is the rough rule of thumb of businesses struggle or fail. So if you're thinking about a bank or a lender who wants to lend to someone who's self-employed, they're lending for 25 or 30 years, it's very difficult for them to make that assessment. But here we are in, the 21st century, gig economy, gun for hire type workers who are out there in the marketplace. So we have definitely seen lenders move in this space. If you had to listen to our podcasting from 2015, 2016, I mentioned many a time there that self-employed borrowers are second-class citizens because of that risk assessment that's being done by the bank. And you had to have a minimum of 2 years.
Treated like second-class.
Treated like second-class. You had to have 2 years of financials to be even considered. Well, the world has moved, and this is why we wanted to bring this one up from a myth point of view, is because by the time the information gets mainstream that you need 2 years of financials and so forth, the credit assessment area and credit policy is dynamic across the 30 to 40 plus mainstream lenders that we have in this country. So I want to just sort of highlight the three main ways lenders will look at self-employees, because they can be very different results depending on which method of lending they use. So some lenders will now take the latest financial year and they will make their assessment on that latest financial year. Some will take the average of the last 2 years, which is the very classic way in which we go. And then some will take 120% of the lower year, unless the lower year is the most recent at which they have just used the latest year. So I know that's a bit technical, but if you just think about it, if you've got 2 years and 1 year's, the second year is completely trumped 60, 80% growth in the year, they won't assess it on that current year. They basically take 120%. So they're sort of saying that's unsustainable growth for that business. So we're not going to give you more money than we're confident that you'll be able to grow that business at. So that's when they use that 120% principle, which is effectively a 20% growth on the previous year is what they're looking at. And so they're looking at that. So there is choice out there in terms of different lenders, and we've got some mainstream lenders who are looking at that sort of just the latest financial year as part of their indicative assessment. Yes, you do have to still jump through a few more hoops traditionally in terms of making sure that those financial records are reliable. And you might also have to ask the accountant for verification on some of those records as well. If they've been done on just a software package, sometimes people can manipulate those. And obviously as a broker, we've got to make an assessment of their credit worthiness, and if they're if they're trying to commit any type of misinformation or fraud activity as part of trying to get money if they're self-employed or whatever it is. So there's a lot going on in this particular point, but hopefully we've just unpacked that banks won't lend to self-employed. They will lend, but you've just got to be aware of the terms and conditions associated with that credit policy.
And it's something that you need to consider too, if that's what your plan is, or if you're currently employed and you're planning to start a business, you need to just be aware that there are Ben said it at the top, that how they assess you as a risk. And one of the things that I observe, Ben, with small businesses is they go for, particularly those that are starting new small businesses, and it doesn't apply to those who are fully across this. But what happens is when you work for someone else, you get a pay packet, and at the end of the pay packet, you get the net amount into the bank, right? So your gross minus your tax, whatever other deductions, all that, but you end up with a net amount that you don't have to worry about. But then all of a sudden, when you move to self-employed, and if it's a self-employed and to the true definition, you're just yourself, or maybe one or two of you, you have to then get into the rhythm of putting money aside for tax, and then being able to pay that tax bill when it comes due, and it happens every quarter. And quite often, a lot of self-employed, particularly in the early years, get that caught up in their own money, and then all of a sudden they might have to drop 10 or 15 or 20 or $50,000 for the quarter. That all of a sudden gets into a bit of a panic, and then we get into cash flow issues, and then we can fall behind on making some of those pay-as-you-go payments as well. So there's a real change in mindset around having to be able to provision for that. And then obviously if you're taking on some lending, throwing into all, the other complexities that happen. So I guess that's something that small businesses need to be aware of. But banks, here's the point. The banks are aware of it. Just because you're going through the experience for the first time and, all of a sudden on a very steep learning curve, they're not. They know what's happening. They know that your payment for the end of the December quarter, Ben, isn't due at the end of January like it is every other quarter, which is the 28th of the following month. It's actually due on the 28th of February. So it gives you a little bit more time. But what happens is you spend a little bit more money over Christmas and on the present spend. And then all of a sudden you go, oh, no, not only do I have to make the payment on the 28th of February, I've got to make the next payment on the 28th of April, which means I've only got 2 months to save up for that one. So people can get into a cash flow chase very quickly. So these are the things that the banks do know when they're trying to assess you as a self-employed, which makes you a little bit more risky than if you're employed by others, Ben.
Yeah, and we want to put the context around this. Obviously, this is what we're talking about here is residential lending, right? So the reason why the banks are flexing a little bit better for self-employed at the moment is they're taking a resi security as collateral, right? So what we aren't talking about here is you starting a small business and expecting the banks to do just a generous lend against your business plan or your business idea. They will very rarely do that. In fact, it's almost impossible to get a reasonable amount of money, and I'm talking in the hundreds of thousands of dollars, just on a business case or even just on the book value of the business or the goodwill in the business. Usually they'll take it against stock. They always want to try and grab some security. So we are just talking about here of people being self-employed. They're going to buy a resi property, or they're going to put residential security up as collateral. And then ultimately that means that the bank's risk of getting their money back is reduced. And that's why they're moving and flexing a little bit in the space of around the servicing calculators and sort of credit policy to actually try and get you the money. So that's a good news story for those self-employed people who are looking to buy resi property.
There you go, folks. Second myth is busted. There is lending for self-employed people. There are just other considerations that you need to think about over and above if you are PAYG for the bank's criteria. Number 3, here's a myth, Ben. Is it true or is it a myth? Here we go. I clear my credit card every month, so shouldn't impact my borrowing capacity. Surely not, Ben.
Well, this is a classic.
The banks know I paid every month.
This is a classic case, Bryce. Sorry to interrupt there. This is a classic case of what history was like then and what history is like now. So it's almost like pre and post responsible lending obligations. So if we go back to 2004 to about 2011, 2012, if you did have a credit card limit and we could show evidence that you paid that credit card off with your auto sweep, remember everyone should have an auto sweep, you pay that off for the 3-month period and we can prove that, then the credit limit would not be considered as part of your lending assessments, and it would not impact your borrowing capacity. So that's the legacy that people have. Well, the world has changed, and now we've got these responsible lending obligations. So a good rule of thumb is that 3.8% of the card's limit will be factored as the monthly commitment. And so the idea behind this is, depending on whatever the maximum limit is, it will be factored in at that 3.8% is the minimum repayments, and that will be judged as an expense, and that's going to reduce your borrowing power. So that is probably new for the last few years, but certainly, for a good decade of when I was doing broking, it was true. That it wouldn't be assessed, but now it is. Now, some lenders will also ignore charge cards as part of that cleared 3 months running, because a charge card is effectively a charge that you will pay off in full. It's not a rolling balance. You've got to clear it, like a Diners Club card or something along those lines. But in terms of credit cards, there's no exemptions for that. You are going to now, that limit is important, so you want to reduce that limit down if you're looking to increase your borrowing power.
Had a mate recently, Ben, who was getting some lending together, and had a lease that they had for the business, and a credit card balance that was too high. So to be able to jockey for position in the current environment, had to buy out the car, had to reduce the credit card down to a much lower limit so that they get the lending over. And on the other side of the lending, obviously there's some options for them to reinstate some of that stuff. But the point is that the number one rule is the banks go, well, okay, you do have a capacity to pay it off, but that $50,000 credit card, you could hock it at any moment. And if you do that and you put yourself in a position that that you cannot service, we will need to have, to your point, as our responsibility to make sure that we know our borrower, we need to assume that could be the case. So here's the myth: I clear my credit card every month, so it shouldn't impact my borrowing capacity. That is a myth that we've now busted, because even if you do clear it every month, in most cases, that's not going to be beneficial to you. It may require you to adjust your credit card strategy. All right, number 4, let's rip through these, Ben. Here's a good one. Why can't you assess my borrowing capacity during this 5-minute phone call? Surely that's possible.
G'day. I want to get $750,000. Found a property that I really like. I earn about 180. I reckon maybe the year before I got a bit of bonus income. I'm sort of permanent part-time. I work in the mines. How much will you let me borrow?
Are you auditioning the castle part 2? Or no?
Look, the reality here is quite simple, that it's for 2 parts, right? There's 2 important points here. The first one is, by law, if you are asking a mortgage broker who is a licensed credit authorised representative under a credit licence, there are requirements, and that requirement is the responsible lending assessment of borrowers. And so we have some compliance work that we have to work through, and that includes evidenced and a proper assessment of the borrower. And doing that over the phone without any supporting evidence is effectively illegal. It's against the law. So for those people who, I get it, in life we want instant gratification, we want quick response answers, but this is a significant investment. So even if someone was to say over the phone to try and win your business, I can't see any problems with you getting that $750,000, Barry. Go for it, mate. Go and buy that property. And then all of a sudden, we find out that Barry's had a default on a phone, his credit profile and credit scores compromised, and now Barry can't get any lending. He's running a massive risk there in terms of the deposit or that he might have paid, and losing all of that and not getting any funding. So it's just a dumb idea to think that you would take the verbal response of anyone over the phone without a thorough investigation of the actual evidence-based information that you gather to make a true assessment, and then get that vetted by the ultimate lender that you choose. I use the example in my own mind, Bryce, around, if I rang, these days you can ring GPs and you can use apps for GPs now. And imagine if I just spoke to that GP and said, really low on energy, I'm not feeling great. I haven't been feeling great for ages. I struggle to get up sometimes, get a bit of dizziness. Oh, mate, you got cancer. Oh, you've got cancer. So bang, you've whacked out this diagnosis, and you're going to put a treatment plan behind me without any thorough investigation of my blood levels, my any of the sort of evidence in terms of the scientific work that we would do. You would just make that judgment call so quickly and irrationally. So this is the same sort of thing. We don't have the capacity to do it, nor would a sensible doctor do anything of that nature. So we're ultimately trying to get to the bottom of the circumstances. So it would be crazy for you to want to take the verbal recommendation from anyone over the phone, because you run the risk of significant consequences if you do.
Folks, it's a big deal. There's serious consequences for those that commit, and so therefore a 5-minute phone call is not going to do it. What if you are based on a 5-minute phone call, to Ben's point, and then you go and commit a deposit, then you go and get a solicitor review the contract, then you go and get a building inspector to go and do that. Not to mention the emotional energy that you will invest in the lead up to making a purchase decision. Not to mention the extreme emotional energy you'll be in if you cannot complete after you've made a decision. So a 5-minute phone call is only to get you in the game. Okay, this is roughly what I'm dealing with, so this is roughly what I can borrow. So you can even just work out if you're in the arena. But the fact that you need to go under, find a bit more detail, see if there's any hidden. To our next question, you'll see a couple of other points that
good segue.
But folks, it is serious. We're not borrowing $5 from mum and dad to go and buy some bananas. We're borrowing money from a financial institution who wants to go and buy a piece of real estate or whatever else it is that you're planning on doing. So that's why a 5-minute phone call won't do. So that is a myth, folks, that you can actually get an accurate borrowing capacity during a 5-minute phone call. The reality is you can get a borrowing assessment with a 5-minute phone call, Ben. But if you want an accurate, actionable, something that you can have extreme confidence in, something that you want to actually keep both eyes closed when you sleep at night, making a major decision, you cannot get the job done in a 5-minute phone call.
Well said, mate. Well said.
But, all right, what's the next one? Here we go, myth number 5. I put my details into the bank calculator and their borrowing capacity is so much higher than what your assessment says. Why? So, sister questions, Ben.
Yeah, well, and this is the most searched item on most banking websites and potentially even most lenders' websites is their borrowing power calculator. Now, we've been very strong in sort of informing our community that every lender has different borrowing assessments, different credit policies, and different tolerances in terms of how much they want to lend you. So what you need to understand is that these borrowing calculators are attraction tools. They are lead generation tools. And it's not very hard to see the big disclaimers that are written all over them that to talk about that they're a guide only, and that a proper full investigation could yield you a different result. And so that's talking to that point in terms of why are they saying I can borrow so much more? Well, here's the reality in terms of people often don't put all of their information in correctly. So some good examples of that might be that they might have casual income or secondary types of income. And a lot of lenders on those standard basic calculators will assess that at 100% of income. Whereas when we actually get into the true calculators that are used by us to assess the different lending options, we have to be very precise about those types of things, and the formulas will adjust for those types of bonus incomes. And we refer to it as income shading in the industry, where they'll shade that income down around their lending policies. Another classic example where people tend to get it wrong is with their HECS and any sort of liabilities that they might also have after their education and higher education costs. So more often than not, because those calculators are again designed within 3 or 4 quick steps to keep your interest and hopefully get you to call them so they have an opportunity to sell you a mortgage. They intentionally design these calculators to spit out potentially over-exaggerated results. And so we do need to condition the borrower sometimes when we're talking to them about, well, how come, the X calculator said I could borrow that? And then you just got to step them through, well, look, let's put them side by side. Here's a situation where the income won't be assessed by this lender based on these criteria. This lender is assessed rental income incorrectly or hasn't done, the negative gearing consequences of that or whatever it may look like. And then the expenditure side, they've forgotten about a credit card that they had, or again, the example that I used around the HECS debt is generally forgotten in the calculation. So it's not a fully transparent and an investigative audit in terms of the household spending and income. And so in most cases, you won't get to the same outcome once we do that full assessment.
In summary, folks, the quality of the inputs in determine the quality of the outputs out. So if you have 100% faith that all the inputs going in, that's going to give you a better chance. But quite often, to some of Ben's points there, you might not have all of the data that the bank needs to form a proper assessment. So in terms of lifting the veil, for anyone who doesn't run a business, Ben, who's listening to this, there's only 5 ways that you can get a new customer. Paid ads, cold calling, content marketing, referral partners, or word of mouth. And anything comes as a subsection of that, right? So to the third one, content marketing, the bank is providing you with content that adds value for them to get a lead, right? You said that at the top, right? So it's just one of the ways that the bank's trying to get a new customer in a crowded environment, because if they go paid ads, it's with every other banking platform across all the platforms that we've got. So they've got to get some cut through. Cold calling, well, we all know how we feel about them cold calling us, particularly when we're trying to navigate lots of commitments between 4 and 7 o'clock. Referral partners, well, I'm sure they're exploiting those channels, and also word of mouth. If you had a great experience with your lender, hopefully you tell a friend, or you had a great experience with your mortgage broker, you tell a friend. So that's work. But one of the most effective ways is through content, giving value, giving people something to take away. And so by doing these assessments online, that is a form of value that they can provide and hopefully be a lead generation tool. That's what it is, folks. It is a lead generation tool. It's not a borrowing assessment. It's for them to start a conversation with you, to cut through the noise of every other person who's trying to have a conversation with you about the very same way that they add value to people's world, which is providing finance. So see it for what it is. It is a lead generation tool which gives you some level of insight, but it's not something that you can go to the bank with.
Yeah, and it's not just, as I said, lenders doing it. It's a lot of mortgage brokers. It's one of the essential things that they have on their website. Now, as a business, we've opted not to do that. We've opted to be really transparent with our community to sort of say, well, that's why we need the detailed fact find. Because if we don't want to set, we don't want to set expectations that are too high. We want to be as realistic and as honest as we possibly can. But I can understand why they do that. The other rich thing that they get is all this rich data about, this prospect who's moving around the web, and they're collecting some data on them in terms of, so ultimately if they return later on, that their profile, their ID profile that they would have captured in their cookies around that particular user will have a bit of a summary for them to also look at as well. So I think from that point of view, just be mindful that they are gathering that information, and then they're also looking for trends. Especially if I'm a big bank and I'm getting maybe 50,000 people visiting the website every month, I'm getting a lot of that sort of data in terms of looking at incomes and looking at ways in which people are trying to look at borrowing assessments. And it's a competitive environment out there. So lenders have to move their credit policies around because they are in the business of building their mortgage books and being able to win market share. So that is the case. But I wouldn't, the point we're trying to make here in terms of the takeaway is I certainly wouldn't be looking at those lenders' calcs and saying that they're reliable, the ultimate answer of reliability comes in the full assessment.
You raise a very good point there, Ben, about a digital fingerprint that you're leaving as well that the banks can use to target paid ads for. So there you go, folks. I put my details into the bank calc, and that's so much higher than what your assessment says. Why? That is why, folks. It is a lead generation tool. You need to look under the bonnet a bit more. All right, next one, Ben, as we whip through these. Interest-only loan assessments are easier than P&I assessments. Surely.
Well, no. So there's a couple of things to look at here. Traditional lenders, or ADI, which is authorised deposit taking institutions, and they are controlled by APRA and the government regulators, will always assess your ability to repay existing and proposed debt using an assessment rate over the remaining P&I period. Let me say that again. So if you have an interest-only period, and that's 5 years, and your loan term is 30 years, the assessment will be done on the 25-year interest-only period, meaning that the repayment rate of that will be on a shorter amortized period of 25 years, where the principal and interest rate will be higher. So those repayments will be higher, which will have a negative impact on your borrowing parameters or your borrowing capacity. So that's really, really important to understand.
Which cake do you want to eat from, Ben? Do you want to have a lower repayment monthly because it's interest only, or do you want to have an easier assessment over the journey because it's P&I? That's essentially what that summarises to, doesn't it?
Yeah, it does. And so when we're answering that question, interest-only loans are assessed at easier than a P&I assessment. That is factually incorrect. However, when you are talking to an investment-savvy broker, there is always exceptions to the rule, because we do know that ADIs, which is the authorised deposit-taking institutions, there are some non-bank lenders where they will extend capacity much further than the other financial institutions' debt. So this is where we come down to this story about, okay, it might be prudent if we've got existing debt with one lender and we need to we're going to buy the investment property, we're going to use another lender to maybe secure an 80% loan against that particular new purchase. And by using these, what we would call second-tier lenders in industry terms, we would use those second-tier lenders because they are exempt from those ADI requirements, and you will start to see maximum borrowing power because they're accepting the repayments in their assessment at the repayment level rather than the assessment at the P&I repayment level. So let me explain that again. If you've got an interest-only loan, to Bryce's point, that means the repayments are lower. And so if this new lender assesses that interest repayment on that lower repayment level, it means you can borrow more. And so that's, again, about the moving pieces that comes together. Only when you're dealing with an investment-savvy mortgage broker will you see their craft and their expertise and their professionalism in that particular space in terms of what's possible for you as well. But to answer the question, interest-only loans assessable are easier than P&I assessments. If it's being recorded as that means I can borrow more with some lenders, there's a half-truth there. But more broadly, no. If you're sort of saying to me, can those P&I assessments be at a higher rate? No, they can't. Not if you're at the single lender that you're talking about, because they will assess the repayments at the P&I level, and that will reduce your borrowing capacity.
And it talks to the previous question too around borrowing strategy versus borrowing capacity versus why the assessments could be even more on a investment-savvy mortgage broker having a conversation versus just staying with the one institution. So we've said this for many, many years, Ben, for as long as we've been talking on this podcast, that finance is like a game of chess. You're kind of strategically thinking about the moves that you're making before you're making this current one as well. So that really speaks to that point as well. So there you go. Another myth for you to think about: traditional ADI institutions versus non-ADI institutions versus people who know how to display their craft around that. All right, Ben, the last one that we're going to tackle today in the finance space is actually an oldie but a goodie, right? And the reason it is an oldie but a goodie is because it comes up a lot And so we're going to talk through it here, but we're also going to talk about a very tragic case study of getting this wrong. So here it is, Ben. Here's the myth that needs to come up. Redraw and offset are exactly the same, Ben. Surely that's true. Isn't it just the banks putting the same thing with a different bow on it?
So if someone was to tell me that the interest charged is exactly the same between redraw and offset, yep, they've got a case. They've got a case to put forward. But it's not just about the interest save that is the beauty of having redraw versus offset. So in redraw sense, the money that is in and out of that loan account has material impact on its purpose. So if we're putting our investment hats on versus our owner-occupied hats on, we've always talked about being in control of liquidity. That's point number one. But when we are thinking about investing versus just running an owner-occupied home, the purpose of the movement of those funds is absolutely material in terms of how we can treat the interest cost. So by way of example, and we see this from time to time, and it's just the person's either unaware or they've had bad advice. But let's say we've got an investment loan and we transferred $10,000 into that loan account into its redraw facility. And then we said, all right, now I want to use that $10,000 loan to maybe buy a car. But wait a minute, that investment loan, the purpose of that was for investment purposes, and that interest is deductible. But now you've blended purpose. And by blending purpose, what you've actually done is now made it very difficult to work out what is the interest cost for the investment side and what is the personal pursuit, which is non-deductible. And so from that point of view, you start to make up this really messy scenario as part of that particular story. And if I can go on a tangent just quickly, lines of credit are classic problems that people do mix purpose inside those particular loans. And so it's an all-in-one type facility. So it's like having a big revolving line of credit or a big credit card. Some people can refer to it sometimes also as, you're able to redraw any time you want. But the reality is if you mix blended purposes inside that and you ultimately set it up for investment purposes, well, the tax office are very, very strict, incredibly strict in regards to how they treat the interest on that particular loan. So please never, ever mix purposes for any type of investment facility that you're running. And so that leaves us with this concept of the offset account being really the flexible instrument that you have, and the real feature that you have as part of the lending structures we can do in Australia, which is I can put money into an offset. It does exactly the same as what it would in redraw, but because I never put it into the loan, I'm ultimately in control of the interest deductibility against the loan. It makes a clear delineation between the two. And so ultimately, my interest continues to be deductible if the purpose of those funds was for investment purposes. So it really is an amazing opportunity that you have if you're thinking and future pacing in terms of your tactics and strategy around how you set up your mortgage.
The ATO is very clear on this point as to deductibility of interest when we're talking about investment properties. It's got nothing to do with security. It's all about the purpose, right? So we've introduced this concept many times around you polluting the loan. And so redraw is simple. If you just think about it as a bucket of water, which represents the loan, you are taking water in and out of that bucket. So it's therefore affecting the purpose of the loan based on why you're taking water in and out. Whereas an offset account is, imagine you've got two buckets side by side. The offset is putting money in the bucket beside the loan, but it is not touching the first bucket. That stays unchanged. So therefore, when the ATO goes, what was the purpose of that loan that has two buckets? And you say it was for investment purpose. Has that ever changed? No, it has not. And because the money transfer is coming in and out of the second bucket sitting next to it. Whereas if the ATO said the same thing, they look at that bucket of water and they go, what was the purpose of that? Well, the original purpose was to buy investment. Has that changed? Oh, a little bit. because I took 10 grand out and I bought a car with it and then I replaced that 10 grand 2 days later. Well, no, that's not important. What was the purpose of taking the 10K out was to buy a car. The purpose was non-tax deductible. So therefore, you have just polluted the loan. You've made the bookkeeper / accountant / tax agent's job a nightmare, and you've just affected the deductibility of the interest, right? So they are not the same, and it comes up routinely and regularly. Now, listen to this, folks. Here's a tragic example that one of our team shared with us that was important for us to share with you. So here we go. A bank staffer caused incredible damage to a client. So they banked with a particular bank, let's call them a second-tier bank, and they had a principal place of residence and an investment property. All the debt was interest only for planning and cash flow purposes. So there was clear intention around why the interest only existed, right? So this particular client called the bank for a rate discount, and they told her to do the following, which she did. Switch all debt to P&I as it's a lower rate. Consolidate the investment equity release into the principal place of residence loan, as there's no, this is quote, as there's no reason to have so many loans. Ouch. Start using the redraw accounts rather than the offset account, as your repayments will no longer reduce based on offset funds once we switch the debt to P&I. Oh my gosh, talk about butchering loan strategy here.
Oh my God.
Specifically use the investment redraw account as it has a higher rate, and the client here we go. This is the bit that's going to break everyone's spirit right here. The client then transferred $500,000 worth of principal place of resident offset funds to the IP redraw account. Oh, even if they try to take that $500,000 out the next day, Ben, the purpose of the loan has changed. Oh, it's demoralizing.
What's that?
It's demoralizing.
Yeah, it's just this is the challenge, right? We've got when you are asking a bank staffer who has no real understanding of strategy and structuring for investment purposes, and they're not trained on it, I suspect, because the banks are always fearful of giving investment advice. But to be able to transfer, like just the last one, transfer that principal pleasure offset into an IP redraw. Oh my God! Like there is tens of thousands of dollars worth of lost tax deductibility for this particular client, all because the bank staffer was absolutely clueless in regards to what's going on. Now, the poor innocent client is thinking that the bank staffer would understand my situation and would think that maybe, brokers do exactly what bankers do, and investment savvy brokers do exactly what bankers and lenders do. Well, it couldn't be any further from the truth. So if this is not highlighting the disaster, this is a train wreck. And the decisions that have been made by this banker that the customer has followed is going to cost them tens of thousands of dollars in terms of their setup. And you can't undo that. The only thing they could do is effectively make a complaint to the bank, work out exactly how much tax deductibility they've lost, and put in a claim. Because that's mind you, that's going to be considered as income, which is taxable. So it is an absolute disaster. So my advice to anyone is never, ever, 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 ever go to a bank for a pricing and then them telling you to restructure the loans because you'll get better pricing. Don't do it. You've got to go back to whoever set the structure up in the first instance to get clarification, because that would have saved this client tens of thousands of dollars, which is a really sad story. And it would have avoided, obviously this mess that now will need to be unwound. But again, in some cases, the nexus is broken on that 500,000 fund transfer into the into that redraw. So that property now is going to turn probably positively geared immediately, and that's going to be tax. That's going to be tax positive in terms of that situation. So the customer is going to need to work out what's in their best interest to either sell that property or to buy another property, or to start to put that money to work in a new investment property as well, and keep that one, because we do ultimately want to get to an outcome where those properties are deriving passive income for us. But it's just a tragedy. It's just a tragedy.
And that's real stuff happening at the coalface, folks. So redraw and offsets are the same. That hopefully has been myth busted. Right here, Ben. I said previously that was the last one.
We've got a bonus one, Bryce. I was going to say that too. I put this little sneaky bonus one in there for you. Sorry about that.
No, I love it, mate. So here it is. I've got plenty of equity. Why can't I borrow? And here's an actual quote from one of our team, right? One of the people said, I own a $1 million, this is from a client giving them feedback just for clarity. I own a $1 million property without any debt, and I've been told you can automatically purchase an investment property for $1 million, right? Not quite.
No. So through, certainly not through an ADI. So we know that as an authorised deposit institution. So banks and mainstream lenders and second tier lenders, they all don't just lend money against equity. Now, again, Bryce, one could assume that the legacy of this could have come from, the low doc and no doc era of the early noughties, where you could do an asset lend. And yes, people might be sitting in listening to this going, wait a minute, I've actually got income coming off the property that I'm going to buy, because I'm going to buy a cash flow neutral or cash flow positive property. And so isn't just the interest, the rent that I'm getting on that property going to cover the repayments? That might be true, but in a lot of cases, lenders will only use 60, 70, sometimes up to 80% of the income coming from the property as part of the income that they assess for borrowing capacity. But factually, it's nigh impossible, because you've got to think about it like this. It's like, yes, you've got security, that's great, but where's the income coming from to actually make the repayments on the debt? So now there might be some sophisticated people listening to this and saying, finish off the story, Ben, dot the I and cross the T. And dotting the I and crossing the T is about private lending solutions. So you might have, say, lawyers' funds or, private funders that will consider giving you a loan against security, because it's effectively not run traditionally through ADIs or through the classic lending or mainstream lending process. They are giving you a loan from a private book of funds, but make sure you understand you're going to pay a king's ransom for the privilege of this, because you're going to be paying a higher interest rate. Setup costs are going to be incredibly high as well. So what are the key takeaways from this? Equity forms part of the bank's security in the event that the borrower defaults on the loan obligations, and ensures they get their money back, right? So, but they're not going to lend the money out if you don't have income. So the ability to make the repayments in the first instance is why the income of a person and what they're generating in terms of that will be what the bank assesses on in terms of giving you some borrowing money. So please, a lot of people, some close to me have also tapped me on the shoulder and says, I've got all this equity, can I just borrow against the equity? Well, you can borrow against the security, but where's the money coming from that in the event that you don't have a tenant in the property, who's going to repay the loan? So that's why, from a responsible lending point of view, it's impossible to do it through classic channels, and you're not going to be able to get those funds. But if you want to go and be very high risk, very aggressive, you can find these private lenders, and they may have an appetite for it. But remembering, they're also taking the security. You don't pay, they'll take the property over. So you're going to, so we advise against it in probably 999 times out of 1,000 times would we advise against private lending solutions for clients.
The 3 C's: capacity, collateral, character. There's 2 other C's, but the 3 C's are what you just want to. It's not just collateral. You got to have the capacity, which is borrowing, and then you got to have some character. You got to have some history that suggests that you're a risk that the bank is worth taking. So there you go, folks. I've got plenty of equity. Why can't I borrow? Probably because you don't have the capacity to pay. So that's the answer there. Not always, but if you think that equity is the game, you probably, when were the low doc years, Ben? They were in the noughties, weren't they?
Well,
So
that was part of the GFC problem, right? So that was when, we had the paradigm shift of equity, I think they called it at the time, under Alan Greenspan. And that
couple of decades late
Yes.
for just thinking that equity was the only thing. And then back in the 80s, Alan Bond did that very, very well. But,
business too. And it all came crashing down. Him and Skase were classic examples of that.
So there you go, folks. We've busted a few myths. It's a bad thing to have all your lending at one lender. We've busted that myth. Banks won't lend to me because I'm self-employed. Covered that one. I clear my credit card every month, so that shouldn't impact my borrowing capacity. We nailed that. Why can't you assess my borrowing capacity during a 5-minute phone call? Well, because we can't, folks. Number 5 is I put my details into the bank calc, and that's much higher than what your assessment says. Why? We busted that one. Number 6, interest-only loan assessments are easier than P&I assessments. We busted that one too, Ben. Number 7, redraw and offset accounts are the same, folks. They are not. We busted that one in the last one we just covered. I got plenty of equity. Why can't I borrow? Well, we've busted that too. So, folks, hopefully this has been helpful. These are some of the common things that we get at the coalface that you may have rattling around in the back of your mind for you or a friend or someone that you know. So next, in a couple of weeks' time, we're going to do buyer's agency ones, Ben. What happens at the coalface of the actual buying? So we're looking forward to that. Next week, we've got a very special guest. So looking forward to doing that. But before we get there, Ben, my life hack today is, did you know that you could get Siri to set reminders based on your location? So you're at a certain location, Ben, you go, ask Siri, can you remind me to put the bins out when I get home, please? And Siri goes, sure, no problem. Reminder has been set. As soon as you get home, boom, the reminder pops up and that gets done for you. So all you need to do is activate Siri, say something like put out the rubbish when I get home. Siri will confirm the reminder and ask if you want it to be set on your current location. You tap yes, and then Siri will set the reminder alert when you arrive at this specified location.
Ooh, that's
AI, it's amazing.
That's pretty good, this
I don't know
AI
if you've noticed there's a bit going around right now. Just when we thought ChatGPT was the only AI that we're exposed to, mate, Siri was doing it long before ChatGPT.
Yes, no, the world is changing. The world is changing.
The world is definitely changing. Hey, what's making property news?
A couple of big stories. Obviously, we touched on the rumours around the Palaszczuk government in Queensland looking at doing a rental cap or rental freeze. They have since walked away from that position, but at the time of recording, our intel is telling us that they'll be announcing a change to the amount of times that you can adjust your rent from minimum of 6 months to be more in line with other states and territories around a maximum of once a year that you will be able to adjust your rent in Queensland. So I think from that point of view,
Right.
I don't. That's an acceptable policy, but it was really important for us when wearing our picker hat, Property Investors Council of Australia. So in conjunction with the Property Investment Professionals of Australia, we did a joint press release earlier in the week where we went out to our brilliant member base of picker and we asked, we surveyed them around what would that mean for them, and they gave us some really honest assessment and responses. And so there's multiple stories out there, but in looking at the realestate.com.au story that we can see, it leads with, to call me a greedy landlord is far from the truth. I'd rather be a tenant. And so there's some really interesting captions of people's situations. It's difficult out there. We don't want to lose sight of that. Certainly if you're a tenant that has been relocated or you have to move out of your property, it's a very, very difficult time. Rental reviews are challenging on both sides of the fence, but there really was some quite interesting messages from some of those investors. So I thought, Bryce, if you want to share a couple of those comments from a couple of them.
Yeah, it's a good one. You were quoted in it, obviously, so you did a lot of work getting this press release out, you and the team at Picker, so well done. But here's a bit that I got out of the article that I think is important for the discussion, right? Many readers argue that if a rent cap was imposed, the state government should also cap rates, water, electricity, insurances, and other costs. Fair call, right?
Yep.
If you're going to affect one side of the ledger, you've got to help impact the other side. But there was a bunch of quotes from some investors, but I'm just going to read out two. The first one was from Lauren. We're going to put a link to this article in the show description so anyone can go there and have a look. I've had a Brisbane property since February 2020 with lovely tenants who are pensioners. I've kept the rents low as they look after the property really well, and I feel they deserve to be rewarded. this renewal period, I've again provided them with a discount to market as a show of good faith for being great tenants. I've raised the rents and haven't been greedy, knowing that they would have had little choice but to sign the renewal given there was no comparable properties in the area remotely in their price range. It is not our fault as landlords that supply and demand economics are at play here. So that's just showing that landlords being reasonable there from Lauren, and this is from Marcus. The land tax alone went up about 25% on my investment properties in the 21-22 financial year, and I just received the latest land tax assessments, and they have gone up again between 18 and 35%. I'm very mindful of trying to keep the rent affordable for my tenants, and I've only just put the rent to one property up by 10%. Some tenants are still paying the same rent from years ago. I haven't even mentioned the increase in my mortgage repayments, which have doubled in the past year. To call me a greedy landlord is far from the truth. I'd rather be a tenant at the moment. Now, Ben, that's where the title came from. Clearly, you'd rather be a tenant with a property right now rather than a tenant looking for a property.
Yeah.
But that's obviously some of the feedback. There's a few others that you can go and read the article at your leisure. But it's kind of just saying, hey, look, don't forget we're people too with stuff going on, with costs that are impacting us. And so if you actually want to interfere with the marketplace, can't you see that has a unintended consequence that you probably haven't thought about, because we'll probably do a U-turn, get out of the market, and then all of a sudden you'll be left with more of a crisis than you thought that this little change or this little tweak would fix. So well done for front-footing that, Ben, at Pickup.
No, and thanks, Bryce, for obviously that opportunity to share that with our community. We'll continue to keep advocating on behalf of property investors out there. We certainly have our backs up against the wall. There's a lot of political persuasion going on in really tapping into that anger, and it's being directed at landlords. And I think that's unhelpful, unnecessary, and that creates a divide. And that might be politically advantageous for parties like the Greens and the left-leaning part of the Labor Party, but it's certainly not good for long-term economic viability and prosperity for this country. So I don't like it, and we'll keep calling it out. On the fun side of what's making property news this week, mate, you picked up a great little story in the Fin review that you shared with me. But it also, before I let you run away with it, because it's a good story, it talks to a momentum change that we are going to start talking to around where prices and demand and supply is at. It does appear the early screen shoots that we were talking about, and the diagnosis that we said a few months ago when we prosecuted our case for where rates are going to be and where property prices are going to be and the bottom of the market and guaranteeing the bottom of the market. This is probably a little anecdotal indication that it's happening in certain parts of the country, Bryce.
Yeah, this is a story in my hometown in Perth, Ben. This is a story by Michael Belieby from the Fin Review. I love their slogan at the Fin Review, Ben, the daily habit of successful people. Yes. I mean, it's they've obviously read James Clear as well, so that's obviously part of their flywheel of making sure people achieve success. So the story was an agent, Vivian Yap, who's an exceptional agent over in Perth with Ray White Dalkeith, was selling a property in the inner western suburb of Floriat, Ben. And we have to remind our East Coast people that the inner west is the blue ribbon stuff over in Perth, because it's closer to the ocean versus the inner east over here. So we're in a suburb called Floriat. And what made this auction, there's not a lot of auctions over in Perth. They don't have the same sort of culture of auctions over there. And there was an article where they were interviewing the agent. So we'll put the link in here for those people who've got the subscription. You can go and check it out. But it says, what was surprising about this particular property? And if I'll quote the article here, it says, right at the tail end of bidding, as things were starting to simmer down, someone walked in and asked if they could quickly register. She'd never seen the home. She walked straight into the backyard and said, I like this house. She came in at the last minute when I was getting my second final bid, which just turned up and goes, I like it. I want to bid. I was talking to the underbidder and trying to get bids from the other bidders, and I said to my team, get a registration form. You can imagine, right? During that time, I was trying to slow down the process of bidding so I could get her engaged with me. I thought we were going to sell it. We're at 1.6 million. I got 1.65. She came in thinking we'd do 1.655, i.e. another 5,000. I said, no, we need more than that. Give me another 50,000. She said, I'll give you another 40,000. So it ended up being 1.69 million. Take it or leave it. She came in strong and then she paused. So how did the crowd respond is the next part. Well, they were in shock. Like, what? They had a minute's hush. What was going on? There was pure silence. I said to the owner, can I sell it if I get to 1.7 million? The buyer said, I won't do it. I said, what if I can get commitment from owner to sell at that price? Would you buy? She said, here's the funny bit, Ben, only if I give my husband a call. They are currently renting nearby, but the husband was in Alaska. He pilots planes. He flies all over the world. She had to do this on the phone on very bad reception. So then it goes on to talk about how, bidding at last minute, all that sort of stuff, right? But someone's just walked in and decided that they hadn't seen the property at the tail end of the auction. They want to buy it, and so that just goes to show the grass shoots that are existing all over the country. I know Florid's probably not your average working class suburb, but for something like that to happen in this property was quite remarkable.
Yeah, and we've said it before, and we'll continue to keep reminding people, the depth of the property market does not need to be anywhere near the depth of, say, a share market, right? Because we only need to have 2 or 3 interested, emotional buyers, and it's a lovely looking property, very character-driven property, to be able to get an emotive response. And again, these are fortunate people who have a good amount of money and income to allow them to be able to take advantage of these opportunities when they see them, and that can move markets. The depth of the demand is the $64,000 question that we were going to be asking over the next couple of weeks, in terms of, we know right now that the demand side is starting to win and property prices are moving in certain markets. But so it's then a question of depth of market, and then what happens when the RBA eventually does pause. And if that's going to happen at the next meeting or if it's going to happen in the meeting after. But one thing's for sure, it's going to be very interesting property market over the next couple of months.
All right, folks, a big episode. We had a lot covered there today, Ben. It was super exciting. We're looking forward to doing the MythBuster series, which we will bring out over this podcast over the upcoming 4 to 6 weeks, as well as guests next week, new guests next week, Ben. First time on the podcast, which is exciting.
Yeah, can't wait. It's we've got some interesting stuff. It's very property research focused. So, that's my sweet spot. That's the area I love to be. So I can't wait to have that conversation. A far-reaching and ranging conversation with some new ideas in there as well. So it's going to be fun.
Well, a little hint there. We're going to be talking about location next week. We're going to be talking about location doing 80% of the heavy lifting, and we're going to look under the bonnet on that too, which is good. But, mate, until next week.
Knowledge is empowering, but only if you act on it.
Well said. See you next week, folks.